Hey guys, Novice going here. I am a novice. This is just my trading opinion, a little video blog for myself. And today I'm going to talk about something that's extremely important, and that is how to know when to buy. And there's many different methodologies out there that tell you when to buy, how to buy. People will tell you that you follow XYZ pattern, or there's a breakout, or whatnot. And those are all, have their merits. But in this case, what I'm talking about is how to know when to buy. And this is based on risk assessment. And the way you have a lot of people that will tell you, if you were on this chart pattern here, there's a methodology where here's the chart pattern, it topped out and it broke away from that. Well, you're about to hit if it hits that point, you put your buy above that point and you get the breakout move. So there's a lot of people that tell you to trade like breakouts. Again, you can do the same thing here where it topped out here, it came back and retested that level, and they're like, okay, buy it if it goes above that level. Okay, that's one methodology, but with the computer trading and all that stuff, a lot of those, there's a lot of false breakouts. It used to be the breakouts, once if it went above a certain level, it just held it, for a long time. Now there's a lot of false breakouts. This is a fairly strong stock, so well, it hasn't been in recent times right here, but at the time that these breakouts happened, it was a fairly strong stock. But what I'm looking at is more of when to buy, and that's based on your risk assessment, in my opinion. So we have a daily here. I opened a bid on it today. Well, green dash is my buy. Man, it's not the perfect buy. I mean, it was kind of like, I wasn't really watching it totally today, so but I have been watching it for a little bit of time. And what you need to do is figure out like what your risk is, what your max risk is. And so if you have a scenario where you have a price moving along, and you figure, well, there's this kind of a support level here, and the stock's moving back down into that support level. If I feel that that support level is going to hold, I can consider that to be kind of like my max risk. So if I just say, well, I'm going to buy it up here, then my max risk is whatever, 5%. And if I buy it here, I'm saying my max risk is 2%. If I predetermine that I want to have a 3% max risk or something like that, and it's different on every stock, on every day, in my opinion, the amount of risk is based on the volatility of the market at the time. You have to assess where the support levels could possibly be. But if I say that my max risk is, and you should determine this based on the stock, if it's a highly volatile stock, your max risk might be 5. If it's a less volatile stock, it still could be 5. It depends on the stock, and you have to kind of get a feel for how they move, each individual one, because different sectors move differently, different stocks in those sectors move differently, and different days of the week stocks move differently. But if you determine that you wanted to take a maximum of a 3% risk, then, and you determine that you have a support level here, then this trade's not possible. You cannot trade it there, because your risk is setting when you can trade. You could say, like, if you had a box, this is my trading range, it has to come within that box, for me to buy. And so you may miss some trades where the stock moves away from it, but you have to set where you believe the best time to buy in. If you looked at a stock and said, you can look at any chart you want over any time frame you want, and you can pick the perfect entry because you can see where it bottomed out. You could say, oh, well, a week ago it dipped at this price point. I see it right there. Let's say I could go back in time and buy it right at that point. Well, that would be a perfect entry. Unfortunately, you can't go back in time at the moment to put on trades that we know of. But the point is, you have to make an educated guess that this is the absolute best entry. And I can either wait for it to come back to that entry and put my position on, and have my 3% of downside there. I can wait for that. That does happen. It does happen semi-frequently. A lot of times they won't come straight down to that price point, especially if it's something that's on a fairly upward trending, daily chart or something like that, or it's in a strong period, you know what I mean? It doesn't always come back and retest the previous support levels. So if you see a consolidation period start to happen and it's above where you feel the perfect buy is, you can either miss that trade if it moves on you and not buy it, or you can say, okay, it's within my risk tolerance. My risk tolerance is 3%. It's 2% into the, what I believe to be the last support level. I can run a stop loss 1% below this, and I'm good. And if this is a good case scenario, because you've already established how much you're willing to risk. And the point of this video is the risk assessment determines when you can buy. So if you choose to buy up here, then your risk assessment is not in play, because you don't know what the downside is. You don't know what the downside is anytime. But based on an educated guess, let's say this thing is bottomed out there like 2 or 3 times. Let's say that's your educated guess that it might not break that level again. If this is a daily chart, or whatnot, or the stock has like moved pretty high above a previous level. Like, let's say this is your previous level, and it's not really a good drawing. This is what drawing on the fly is not the best, option here. But if it doesn't matter if you're using the bottom of a wave to determine when you're going to buy in as a support level, or whether you feel that it's going to bounce off the top. However you determine your risk is, let's say you had like this deal here, where, okay, well, here it is. I feel that might bounce off that level, and it's not going to come all the way down to the trough. So there's your risk assessment. You're like, okay, well, if it comes within 2% of that, I'll buy. If it breaks that level, then you made the wrong call. You're going to be wrong, and you have to admit when you're wrong. So, and you could have been right on the assessment, and then something came out in the news or something like that, or the market as a whole decided it didn't like what was happening. So, different factors. You could have been right up until the point that a Fed speaker started talking. But the way you determine where you can buy the stock at is not necessarily, well, it's going to hit a support level, so I'm going to buy it there. It needs to be determined on what's your risk, because otherwise, if you feel like, well, I'm going to buy this thing because it hits the support level, you can do that and buy the support level, but you're going to miss a lot of trades because they don't always come to support levels. So it's better off, even if it does come to a support level. Let's say, well, I'm going to buy it at this support level. Well, if you're considering that you have 3 percentage points of risk, you still need to set your stop right there. You know what? I'm going to buy it at this support level, but I still have my risk is still set. Because let's say like the next support level is, down here, and you buy it there and it breaks the support level, well, you're just like, well, okay, we'll just go to the next one. Not really good. You need to establish like how much risk you're going to put on. And in my opinion, if something's hitting the support level, then your risk needs to tighten up even more. Because chances are if it does break that, then, there's downside coming. So it's important, in my opinion, to determine the risk. And I could show you on this trade that I did here. Now, this is still an active trade, so who knows what's going to happen with it. But I like to look at it from a daily to 5 minute to 1 minute. That's what I do. So on my dailies, I kind of said, well, you got a resistance level here. There's a little bit of a resistance, from back here. And so when I would look at this trade, I would say, well, where do I want to buy this at? Well, if I want, the bottom of this is 3%. You can see the percentage shows in the middle of the blue box there. But the bottom, basically, this resistance level here is 3%. This level here is 3 percentage points away from where I bought. So I'm saying I'm going to risk 3%. I actually did a half buy, 50% position, because I will buy another. If it does come down in here, my max percentage of risk, I will buy a second position with a very tight percentage of risk below that. So I'll have 3% downside on my first position, 1% downside on my second position. But just because I know the stock, I don't necessarily know that. I mean, I'm even thinking that even if it breaks here, that I'm out, and that's only a percentage point of risk. So it depends. I'm still not really seeing this one being super strong just yet. So this is not, like I said, this is not the perfect example. But if I switch to 5 minute, and you look at the same trade, I was watching it. I saw it hit some support levels. It hit some resistance here. It had some support here. It broke through that support level, but then came back to it. And when I saw some buys coming in here, that's when I opened my position, because I figured my max risk was the low of the day, which was less than 0.5%. So my max risk on the day was 0.5%, which is where I actually set my stop loss for the day initially. I said I was going to risk 0.5%. Well, when it took off, I brought my stop loss up. So my max risk on this trade is now 0.05%. I have no risk in the trade unless something ridiculous happens pre-market, during pre-market trading, or after hours trading, which those always suck when that happens. So you have to watch your positions during those time frames. But you can see that I brought my stop up when max loss is up, and so if you actually see a little better on the 1 minute. But, there was a big kind of bouncing around period through here, and it broke it. But it previously bounced off of it, went in there, and now it bounced off of it again, went in there, and it came back. When I came back a third time into that area, I was like, okay, this is starting to show a little support in here. So that's why I bought there. That's not my prediction. The reason why I bought it's not important. It's how I calculated the trade. if I was gonna buy like right on the bottom here, like if you saw this chart and it was doing this deal right here, like you can't buy that. People were buying it. Who knows? They got lucky. They had lots of money. Who knows what? You just started buying it, and you could have bought it off of other things. But like if you see that, it's like it's really hard to buy that because you don't know what you're risking. You could say, okay, I'm going to risk 1%, well, just buy. But if you had done that up here when it consolidated, you're done. So the best thing to do is try to find a support level that seems to have some sort of. The best way to do it, in my opinion, well, no, we're not going to get into that. When you see heavy sells at the bottom, followed by buying support, is usually that's a way over average sell, then supported by below average buying, but that propped up the price because there's no sellers left. Which, but you had kind of like this kind of resistance level. So I kind of figure, okay, I have a resistance there, I got some resistance here, got some resistance here, or support. That's probably my max loss on a day, is the low of the day. If this thing could go south on me, okay, 0.5% of risk. But I only put in half a position because of that calculation, because I wasn't totally in love with the chart and what was going on with this stock at the time. But my buy was based on how much downside risk there was. And then now that it's moved up, I can bring my stop up a little bit. If it triggers, whatever. I lost, my commission. The trading commission. I did not bring that stop up immediately, as you can see with a trigger right there. But my daily stop was here. That my max daily stop was here, and that's why it's important not to move your stops too soon, especially if you're not 100% in love with what's happening. And I would have traded out of this early before when it hit up here, but I was doing other things at the time, so I'm satisfied with that trade in that position. Not the best example because this is kind of wishy-washy kind of day, but the point being is that you need to find your risk, and then use your risk to establish when you can purchase. And you have to establish your level, how much risk you're going to have on that level, and then you got to wait until that price comes within that risk zone in order to buy. Otherwise, you're going to end up you're essentially saying, I don't know what my risk is. It's whatever it is at the time I buy. Well, one time it could be 5%, it could be 2%, it could be 8%. If you buy and you're too far away from, when you buy, that is your set risk, whatever you feel like your sell would be at. If you haven't pre-established that, then you're flying blind and you're going to make a lot of mistakes because you don't know what your risk is. You don't know how much you're willing to lose. And I would caveat this by saying that position size, small positions create larger amounts of risk because you have to hold, those positions have to move in your favor a lot. And it means you have to be in a trade usually much longer to get that outcome. So by having a small position size, you increase your risk, essentially, because of time factors and correctness factors. But figure out how much you're going to bet, figure out how much you're willing to lose on that bet, and then set that versus your levels. And then you have to wait. That's the hardest part. You have to wait until the price comes into those levels. Otherwise, you're changing your risk immediately, and you're gonna make decisions where you buy. Your risk isn't, you don't have a good risk reward setup, and you've instantly added a lot of risk, a loss potential. Because if it starts dropping, you're like, well, you just didn't learn the stock very well. You didn't learn things. Because you can't say, well, my stop loss wasn't very good. Well, your buy wasn't very good. Because if your stop loss is too far away from your buy, it's because you bought at the wrong time, because you just increase your risk for no reason. Because you're impatient or whatever, you just felt it was a good time to buy. And it happens. But it's much, much better if you can set a risk amount, find the support level, then calculate your risk, and the risk level needs to be below that. What I mean is, if your max risk is 3%, you can't buy when the stock comes within 3% of the what you feel is going to be a resistance level. You have to wait until it hits 2% near the resistance level, because you cannot set your stop losses at the resistance level. A sheer way to know you're trading wrong is when you get stopped out and the stock immediately reverses. It's because your orders were the last ones to fill. You were the only one at that point, and the computers triggered it, or they like sniffed it out or whatever. If your risk is set a certain amount and you wait to buy, and your stop loss is well below where the computers, anybody else is not going to come in and buy or should buy, it's going to be very hard for those computers to punch it all the way down. But, if you're saying that this is 3% risk, and you're only half a percent, but, your stop loss is 0.5% below the support level, you're done. It's not gonna work. But let's say you waited for that thing to come into within 0.5% of the where you would stop out. You could set your stop 2.5 below that. It's gonna be much even harder. I mean, now the chance what's gonna happen is you're gonna miss trades. You're either gonna miss the trade because it's never gonna come that close to support levels or your risk, where you want to set your buys and stuff at. Or it's going to just fall straight through it, and you're going to be like, wow, it's a good thing I waited on that one, because it just kept on dropping. The ideal thing is to have your risk set wide enough that, if you can do 3% is pretty good, in my opinion. But once you start getting over 5%, it starts hurting a little too much. Unless you're doing multi-buys, multiple positions on it, and your first buys are small. But now we're getting way off track there. But the point is, set your risk level. Imagine that it's a box, and within that box you have your resistance level, when you're going to leave, and when you're going to buy. Because you don't necessarily want to buy at the resistance level, because they're not always going to hit there. So if you have 1%, if you're going to say I'm going to buy within 1% of the resistance level, I'm going to risk 2% on that trade. When the stock comes into that area, you can buy it, and there's no better feeling in the world than buying something near where you feel the stock should reverse, and being like, okay, I know I only have 2% or of downside, or 3% of downside. That's it. And if it doesn't hit that level, you're like, man, that was a sweet trade. If it punches through that, you have to say, I was wrong. I did not have the resistance level, predicted correctly. But this is the scenario when you have to have your buy, your predicted resistance levels or reversal levels, and your stop. And if this is your max risk, the lower you can set your buy, you're gonna set your stop even lower. I mean, your max risk is still 3%, but you're giving yourself more room. You're giving yourself more room because you just waited and waited and waited and waited and waited. Or you could be you could really try to hit it good and like set your buys like right at the resistance level, or you could break it up into multiple buys right there. But the calculation all has to be set up. You have to have a max risk on that position. So good luck, guys. Thumbs up, like, subscribe, all that YouTube fancy fare if you so choose. Good luck.